Coming up today, stocks close higher, with inflation continuing to cool. The latest trade from billionaire hedge fund managers, a massive cyber attack on Iran, and we just got an ominous signal for the stock market. You don't want to miss this one, guys. Let's go. And welcome back, Click Capital community. Another day of high highs, high lows in the S&P 500 as we continue to grind back from that sharp sell-off starting last week, with market color turning very bullish across the board. Red everywhere the bulls want it to be. Volatility, bond yields, oil, the dollar, and inflation expectation all back to trending down. Two weakest sectors out there, energy and consumer discretionary. Now got the S&P 500 just back above its 50-day volume weighted average, as is the equal weight S&P. Mega cap tech composite chart still not quite there, as is the Nasdaq index. Dow Jones Industrial just closed above its 50-day today. Mid caps not quite there, and lagging behind in this bounce, the Russell 2000 small caps. Still a little bit below the 50-day. And just looking at market structure in terms of breadth, we still have little mixed readings. Good news is 2/3 of stocks still above their long-term moving average. Still not getting the best readings on 52-week highs versus 52-week lows. And look at this crush in the VIX index. Just truly impressive how hard it can come down when it does crush. 65 last Monday. Here we are on the following Wednesday, down at a 16 handle. And I would think around these levels and even lower could be potentially offering a bit of a buy the dip opportunity in volatility. There's different ways to play it. My preferred way is with a bullish call spread in VIX options, where you go long and in the money call option and sell and out of the money call option. You kind of neutralize the Greeks and even create positive theta on the trade. That's one way to do it, because I can also see the price of out of the money put options coming down and the put call ratio dropping as well. And I can also see that in options volume data today. Now getting back to majority call options being traded, 58% calls versus 42% puts. And since most of the options market is trading near dated options, 57% of them expire in 5 days or less. A lot of the market just chases recent price action. So like I said, anyone worried about any further potential volatility, the election, the Middle East, the VIX at 16 or even lower over the next couple of days, week or so, may not be a bad time to pick up a little insurance, a little hedges for those that wish to do so. One thing's for sure, it's a lot better to buy insurance down here than it was last Monday up here, like many people were doing, jumping over each other to buy put options. You can see that in the volatility of the volatility index. Something you kind of want to watch for the price of options as well. It's a great time early last week to sell puts. However, coming up now may not be a bad time to add a few puts if you're into that sort of thing. And stick with me today because I've got a real interesting one for you. I'm going to cover inflation. Then I'm going to show you the latest moves from billionaire hedge fund managers. Just had to file their second quarter Form 13Fs, letting us know what stocks they've bought and sold. I think you'll be interested to see some of the moves they've made of late. Just looking at the 2-year yield, 396, had a little spike up after CPI inflation data came in as expected today. We just got a 2 handle for the first time ever in this cycle, with the headline year-over-year reading coming in a touch better than expected, 2.9%. That is good news, and as I had been expecting as well. There's a 10-year 383. High-yield bonds creeping back to yearly highs. That's a good sign for risk-on sentiment. And like I said last week, why I didn't think it was a big risk-off structural change in the markets is the dollar index was trading down. Typically, if you see a real risk-off move, especially with something like the yen carry trade apparently blowing up, there'd be a massive rush into dollars. We just didn't see that. So that's bullish for stocks. And there's the yen stabilizing as well, coiling up, and for sure we could get a retest down. Like I said, wouldn't be surprised to see this candle retested. However, I'll be looking for support there. We should form a major bullish divergence if we have seen the worst of it with the yen carry trade. Bitcoin still consolidating here. Seems to be equal forces of both bulls and bears, keeping the price in a bit of a gridlock. Gold still holding ground, and crude oil continued its pullback today. And we've got market leaders Nvidia reclaiming the 50-day VWAP. Another nice move up in some semis like ARM Holding. Started last Monday. $98 a share. Here we are. $125 a share. And financials were quite strong today. Berkshire Hathaway up 1.4%. And stick with me because I'll show you what Warren Buffett's latest moves have been as well. First, let me just share some data, research, and news with you guys to get you all updated. Here's a visualization of the bounce back we've had from last Monday low. Had a pretty good bounce in tech. Nvidia up 30%, Bitcoin 20%, Meta 17%. The Nikkei, which was leading all the fear, has actually reclaimed all those losses already, along with a lot of other big stocks having a real sharp bounce back here. One thing I noticed recently as well is an ETF you may not have heard of. The Invesco S&P 500 Top 50 owns the top 50 stocks. All of a sudden, the last 3 sessions, especially after that Monday low, it's had a huge amount of volume come in. Triple daily averages. So it looks like a lot of institutional money is still betting on large cap growth, and there's the spread of the Russell 2000 versus the S&P Top 50, that ETF XLG. You can see it's having quite a bit of a pullback after we had a real blast off last month. So a bit of volatility in this small cap rotation trade. And so we're in the month of August. The last 2 August months we had in 23 and 22 actually finished lower. September even worse. The last 4 Septembers we actually finished lower on the S&P 500. Some of them pretty deep. 2 at 5%, 1 at 9.6%. So like I said, if the S&P doesn't go below 5,000, that's really the best case scenario. If we can make it to the election, still holding a 5 handle on the SP, that would be the market showing a lot of resilience in an otherwise seasonally weak period. Another technical signal we just got, S&P 500 surging over 4.5% in 4 days. Looking back in history, when it does that and it's above its long-term moving average, 84% of the time, it's higher a year later. So a bit of a momentum burst when the market's already in uptrend is quite often a bullish thing. And all throughout financial media, headlines a bit over a week ago, after the jobs report came in a bit hot, was a SARM rule being triggered. It's basically another way of measuring unemployment trending up, typically associated with recessions around the corner. However, just looking at history, US stocks typically trend down or go sideways in the lead up to the triggering of the SARM rule, as they're kind of pricing in a recession. They see what's happening. However, here in the red line, we've been trading a lot different, a lot more stronger going into the triggering of the SARM rule. And in fact, I think a lot of people would be surprised to know that on average, the stock market's higher 12 months later after the SARM rule's been triggered. Of course, we can get those nasty recessions like we did in 2008 in the red dotted line here, and in 2001 after the tech bubble burst. However, there's even instances where the stock market's finished 25, 30, even 40% higher a year later after the SARM rule has been triggered. And just keep in mind the 2 big forces that drive the stock market. That's the economy, GDP growth, which is still tracking around 3% for the year, and corporate earning. That's what stocks correlate with the most over the long term. Just getting to the back end of Q2 earnings season, we got better than average 79% of companies beating Wall Street expectations on how much money they made, with the absolute year-over-year earnings growth expected to come in at 11.2%. That's above expectations as well. So just imagine that. You've got a business and your latest quarterly earnings are up 11% year-over-year. That's pretty healthy growth, double digits. And the sectors leading that growth is technology, energy, communication services, real estate and healthcare, with staples, industrials and materials coming in the weakest. And apart from emerging markets, we've got Euro stocks, Japanese stocks and American stocks. The earnings sentiment, that's analysts upgrading versus downgrading, is actually trending higher. And you can see in the dark blue line, that's been trending up the last year and a half as well. What also gets me excited and why I love investing in small caps is not only do they have way more potential for appreciation just in general, being smaller, lower priced companies, but the fact is we're starting to reach records in the number of consecutive days the Russell 2000 has not surpassed its prior high. Now getting towards 700 days, looking back in history, we've only seen 2 peaks above that, in 08, 09 and the early 2000s. And after that time in the early 2000s, small caps went on to outperform large caps for another 10 years. And so small caps will eventually break out again, and I'm looking forward to when that eventually happens. Contrasting all that bullish research and data is looking at this scatter plot chart of the S&P annual performance versus the VIX's yearly high. So that's the highest print we get in the VIX for the year, and then what was the annual return for that year in the S&P. There's the 0%, negative territory and positive territory up here. You can see here in the green, 2024, we just printed a VIX high of 65 last Monday, and like I said on that day, I'd put it about 80% chance, probably higher, that was the high for the year. So far, we're tracking around 12% performance or so. Looking back in history, only 2 other years we saw a high VIX, 2020, 2008. One of them was really down. One of them was moderately up. However, looking back at all VIX yearly high prints above 45, we can see 1, 2, 3, 4, 5, 6. They either finished flat or down somewhat, and then 1, 2, 3, 4, 5, 6 that finished moderately or very high, did really well. So it's almost a 50-50 when we get a really high VIX print for the year. Bit more tilted on the bullish side, just by the average returns versus the bear returns. And this is a real outlier, 2008. The odds of that happening anytime soon are very low, depending on who you listen to, of course. And what markets love is cooling inflation, especially when we've still got economic growth. Got CPI printing a 2 handle for the first time in this cycle, and like I've been saying for months and months, as soon as we got that 2 handle on CPI, I think that could be the green light for J Powell to go ahead and start trimming rates next month. Because at 2.9% year-over-year change, that's the lowest print we've had since 2021 before inflation really took off. And with that little bit of a scare in the jobs market a couple of weeks ago, that's another reason for them to maybe dial risk back. Another thing that could help inflation is something that's probably contributed a lot more to it than what people realize. A huge influx of immigrants into the United States. over the last couple of years. In the light blue is authorized immigrants that came in legally. In the dark blue, you can see there since early 2021 when Biden reversed a lot of Trump's policies at the border, unauthorized entry into the United States skyrocketed. That's been pulling back a bit, especially if we see a change in the White House, that could drop a lot as well. And so basically immigration spiked a lot more than the supply side for many industries, products and services. It's a lot more elastic than supply is. And so supply, which is really lagging, investments, infrastructure, logistics, has increased to handle all that. However, like we see in markets, we can see in economies a lot of symmetry, big swings around an average. And wouldn't it surprise a lot of people if in the next year or two we started looking like deflation, started getting CPI on a one handle? Pretty sure no one's expecting that. However, like Goldman Sachs expects, they could really go low in the next year or two, and that's likely to help inflation in the States as well. Looking at another leading indicator done by Nordea and their regression model, shows US core CPI continuing to nosedive down towards the low twos over the following 7 months. And so I'd put it 70-80% chance Jay Powell is going to cut next month. Of course, we'll get a taste of that in Jackson Hole when they all meet up next Thursday, Friday, in which I would expect him to hint towards that as well. Getting a bit of volatility in Fed fund futures, as we quite often do. Now back to 63% chance Fed will cut 25 basis points. However, still pricing in a lot of cuts over the next year. Still think we'll be down in the low threes by next July. And we live in a synchronized world. How we're getting a few checkered reading on CPI inflation, the trend versus the prior reading. There's the states coming in lower. However, we're still getting a number of higher readings as well. I wouldn't say inflation's completely been put to bed. It's definitely trending in the right direction. But of course, there's always the risk of resurgence. Inflation quite often looks like a sine wave. Up and down, comes in waves, spikes, dives. But for the here and now, things are looking pretty good. Okay, as promised at the start of this week, I was going to let you guys know the latest moves from notable billionaire hedge fund managers who've just filed their Form 13Fs. They're required by the SEC. Any fund that manages more than 100 million has 45 days at the end of each quarter to file their Form 13Fs with the SEC, letting them know what their trades have been and what their positions are. And so I'll go over a few notable names. I'll let you know Stanley Druckenmiller at the end. I'll show you what moves he's made. But first we'll start off with the granddaddy of investing, Warren Buffett. Surprisingly, just started a new stake in Ulta Beauty and actually sold Snowflake. And here's a look at Mr. Buffett's portfolio. There's that big trim he did in Apple. Chopped it in half. Still owns 400 million shares, 30% of his portfolio. His current stock portfolio is 280 billion. He's always operated Berkshire Hathaway, kind of like a holding company and hedge fund. He either owns businesses completely outright or he owns a share of them through publicly traded security. Coming in number 2, Bank of America 14%, American Express 12%, Coca-Cola, which he has a long-term affinity for. Back when Buffett was a kid, he used to buy 6 packs of Coke cans from, believe it or not, Charlie Munger's father's store back in Omaha, Nebraska, and resell them. He bought his first stock at 11 years old, famously said he was messing around for 10 years, and since then, has been investing for almost 85 years. Sold shares in Coke for about 50 years, and I'm pretty sure he'll never ever sell them either. Coming to number 5, Chevron, Oxy, and some of his other long-time favorites. He's still got him there. He added big time to Sirius, 262%. And there's his new buy, Ulta, and another small position in Heiko. But we don't know if that's done by his 2 proteges, Ted and Todd, or by Buffett himself. But overall, as we know, he was a net seller in the quarter. With almost as much cash and short-term T-bills and the like than he does have in stock, no doubt he probably doesn't like the valuation of a lot of stocks out there. However, he could also be preparing for another signature purchase, maybe the signature purchase of his career before he likely retires in the next year or two. Moving on to the always colourful Bill Ackman of Pershing Square Capital. Interesting to note, he started a new position in Nike, just a small one, 2.2% of his portfolio. He also did a bit of trimming as well. Top position still Hilton, Chipotle, Restaurant Brands, and Alphabet. Charlie Munger's protege, and the only other money manager that Charlie Munger trusted with his own money. Munger famously was an extremist investor, very concentrated. Quite often only hold 3 or 4 positions. Most famously, Berkshire Hathaway, Costco, and a private partnership with Li Lu, Himalaya Capital Management, in which he just reported one trade for the quarter. He bought Occidental Petroleum. Largest position, still Bank of America. Another protege of Charlie Munger. Monish Pabrai follows in the footsteps of Charlie, being a very concentrated, high-conviction investor, quite often focused on deep value. He added to his biggest position, Alpha Metallurgical Resources, Arch Resources, and Warrior Met Coal. Interesting to note, these are coal mining companies. Pretty much been given up on by the market. They trade at very deep discounts relative to their cash flows. He's obviously betting they'll come back, even if it is just a fair value, as coal likely still has a few more years left in it. The even more colourful Michael Burry, portrayed in the movie The Big Short by Christian Bale. Made a few moves in his portfolio for the second quarter, added to his largest position in Alibaba, bought Shift 4, Molina Healthcare, Hudson Pacific Properties, a few other small positions. So along with Baidu and JD.com, you can see he's betting on Chinese security. Another good hedge fund manager with a long-term track record. Daniel Loeb, third point. Larger position still Amazon. Did reduce Microsoft, Meta, and Alphabet, but he bought Apple and a few other small positions here. However, he runs a much more diversified portfolio, as you can see. David Einhorn of Greenlight Capital. Quite often see in the financial media. And all these guys used to get so much more spotlight and attention in the financial media in the mid-late 2000s when kind of hedge funds peaked out. Around 2009, 2010. A lot of them have underperformed the S&P since. It's been very hard to keep up. However, they still manage billions of dollars. David Einhorn, largest position. Green Brick Partners, 29% of his portfolio. Head and shoulders above his other positions. He's also got some energy names. Also interesting to note, he reduced his position in gold. Still a small part of his portfolio. And he bought Peloton, which has been beaten down for a long time now. And Capri and IAC. Just looking at his largest position, Green Brick Partners, home building company. Coming out of Texas, it's actually a small cap, $3 billion. Looks pretty good on my fundamental indicators. Fair value as well. Can't say the same for Peloton. That looks like it's been beat to death. He's obviously betting on a bit of a turnaround situation here. $1 billion market cap. Anyone remember this back in COVID? Man, how different it was back then. Traded up to $170 a share. Wealthy consumers stuck at home. Buying a treadmill with an iPad attached to it. Everyone thought it was the future. How often we see this in markets. Things change. $170 a share, now at $2.80. Another great hedge fund manager with a long-term track record of outperforming David Tepper, significantly trimming his exposure to mega cap tech. Largest position still Alibaba, like Michael Burry. Also owns Pinduoduo, iShares China large cap ETF, Baidu, and JD.com. He's obviously betting on Chinese securities as well, in which he increased his position in FXI and KWeb and JD.com. And the fundamentals are pretty good on Chinese securities, especially looking at valuations. There's Alibaba. JD.com, my indicator's got it at 38% undervalued, and Pinduoduo, 45%. David Tepper is bullish on these stocks. And finally, one of the best, if not the best, in hedge fund management, Stanley Druckenmiller, in which he's quite often known for doing a top-down strategy, looking at the macro, then choosing his bets based on that instead of bottom-up analysis. More like Buffett, just looks at companies he knows and understands and can buy at a reasonable valuation. Stanley Druckenmiller decreased his position in his largest holding, Coupang, increased in Coherent, Natera, Vistra, Seagate, sold 64% of his shares in Microsoft, interesting new holding in Philip Morris, Mid-America Apartments, and also interesting to note, he sold shares in Palo Alto and 87% of his shares in Nvidia. It's now less than 1% of his portfolio. Also interesting, new holding in Palantir and Adobe. So there's a look at Nvidia, David Tepper, Stanley Druckenmiller, significantly trimmed. We are getting a few mixed signals here in technicals. Fundamentals are still trending up. Valuation's not that bad, 32% above fair value. However, Stanley Druckenmiller has taken a liking to Philip Morris. Kind of like coal companies, tobacco companies can quite often trade at a discount. As with ESG investing, a lot of big institutional money is simply not allowed to touch them. And believe it or not, Altria Group, another large tobacco company, is actually the all-time #1 performing stock ever in the stock market. And we can see that in this article here from Investopedia, a list of the best performing stocks of the past century. Recent study from Arizona State University analyzed the price history of more than 29,000 US stocks that traded between 1925 and 2023. Some of the best performing stocks: Abbott Laboratories, Johnson & Johnson, Pfizer, General Dynamics, Boeing, Northrop Grumman, Coke, Pepsi, Hershey. However, the king was Altria. 265 million% return in less than 100 years. No other asset comes close to that. Even Dow Jones Industrial, which is head and shoulders above bonds, gold, everything else, did 24,000%. And we've only got data and trading view for Altria Group going back to 1968. However, just looking at a logarithmic chart here, split adjusted started at 11 cents. Here we are at $51, not including all the dividends. And if you reinvested all those dividends, that's how you create a compounding machine. However, I'd say the future is a bit more uncertain when it comes to tobacco and nicotine products. And so you'd need a bit of margin of safety to account for that, in my opinion. However, just on principles, I wouldn't invest in tobacco stocks either. Okay, to the title of this video, the ominous signal we just got for the stock market. And I hate to hate on a guy, but he's making another market call again after he said he wouldn't, and he's had a pretty shocking track record these last few years. That's Morgan Stanley's Mike Wilson, who just came out and said he doesn't see a major stock market collapse despite the recent sell-off, and that just made me cringe when I saw that, and I'll show you why. In March last year, he came out and said, "Sell any bounce on this government intervention, the next leg of the bear market has begun." March 13, 2023. And that was right there where he pretty much nailed the low when he said to sell any bounce. March 2013. S&P 500 was at 3,900. Then in May last year, he said, don't be fooled into thinking this year's stock rally is the start of a new bull market. May 23 last year. And there we are there. May 23. Said it's not a new bull market. 4,100 on the S&P. Then he comes out on July 26 and admits he was wrong about a plunge in US stocks as the market was clearly rallying up. And there's July 26, where he admitted he was wrong and started to turn bullish again. Believe it or not, market made a high the next day, pulled back for another couple of months until we made that low in late October last year. Then at that period, on October 31, he came out and warned investors not to get their hopes up for a Santa Claus rally. And again, he almost nailed the low by 2 days by trying to warn investors to stay out of the market. Of course, we went on for an epic Santa Claus rally into 2024, and we've continued to rally up since. Then he copped so much flack for all of this, got demoted from Morgan Stanley, said he's done making calls on the S&P 500, and now he's just come out and said he sees few signs of a bear market, doesn't think they're going to plunge. And as a bull, I wish he would just shut his mouth. He's really jinxing us here. So hopefully he's not wrong for the 10th time in 3 years, because a broken clock is right twice a day, right? So hopefully that's one of those times. Just moving on to the global macro, geopolitics and commodity. Didn't get a huge move out of CPI today. I think the market was kind of already expecting it. Bond yields hanging around the same levels. I think what we'll really be looking forward to is the jobs report, the first Friday in September. Fed will get a look at that before it meets on the 18th, and I'd say that will really cement their view. If that were to come in at 4.3, 4.4, so they're very likely to cut. Maybe even if we get a nice improvement down to 4.2, they could still cut as well. Just looking at market implied probability of a recession, very low that we're currently in a recession already, like a few financial channels will try to have you believe. The market's actually given that about a 6% chance that we're already in a recession. However, the probability of a recession starting in the next year, they've got it 41%. However, that's really skewed by the 12-month forward implied change in the Fed funds rate. As I just showed you, as pricing in a huge amount of cuts, pricing in a big recession over the next year. However, you quite often find Fed fund futures forward pricing curve can get quite a bit ahead of itself and is quite often wrong. Looking at other indications of the probability of a recession, MBS spreads, high yield spreads, cyclical versus defensives, 10-year, 2-year, and not shown on here. They're all given a low to moderate or very low, like high yield bonds have given a really low chance we're going to see a recession, and especially the stock market doesn't look to be pricing in a recession. And like I said, don't place too much weight on that Fed fund futures curve, as it's almost always wrong about what the Fed will do in the future. Quite sensitive, and the fact is, it's very hard to predict what interest rates will do in the near-term future. Even though it seems like it's not, don't be fooled, it is challenging. And why a lot of big investors, Warren Buffett included, are shying away from long-term US government bonds, keeping pretty much all of his liquidity in short-dated T-bills. It's because the exploding US government debt. Coming into the global financial crisis, 2008, was below 10 trillion, and that 15 years has more than tripled. We're now sitting above 35 trillion, and that's accelerated since 2020 as well. The amount and pace of current US federal government spending is just simply unsustainable. Something will have to change. Moving on to commodities. Got oil pulling back, still on edge with Iran and Israel. Do have some soft signs of demand and demand forecasts going forward. Global economy is kind of in a flux. Got a bunch of central banks cutting, getting some mixed data, especially from China. Could really go either way here, and that could be potentially affected in the coming days with how Iran responds to Israel, as they've vowed severe punishment for the assassination of Hamas political leader. And we've just got news that there's a massive cyber attack on the central bank of Iran. Apparently ATMs around the country are shut down. Computer systems of the banks were paralyzed, and this level of attack is likely state done. Probably by Israel, maybe with the help of the West, maybe trying to stir the pot and tip Iran into giving a response. Maybe Israel wants to use this opportunity to shut them down, as they're said to be on the cusp of developing a nuclear weapon, which poses a real risk to Israel, as Iran's expressed publicly for years now they wish to wipe Israel off the map. However, Israel's not going anywhere. There's only 16 million Jews in the world. Israel's their only home state. They're surrounded by 28 Arab countries, over 500 million Arabs, and even the Quran acknowledges Jews were in Israel thousands of years ago. They had to have come from somewhere, right? So they see Iran as an existential threat, and they have the capability to deal with that, like it looks like they're already starting to do. And we could see a similar situation in Taiwan in the years ahead. We've already got America delivering advanced artillery rocket systems to Taiwan, potentially looking to deter a Chinese invasion or respond to a Chinese invasion when that happens. So like I said, elevated geopolitical tensions is not going anywhere. It's likely to remain for years ahead, and that should give a tailwind to gold, which has been trading firm all year. We started off just above $2,000 an ounce, and here we are. We're already up 20% of the year. outperforming the S&P 500. And that's pretty much a wrap for today, guys. We got retail sales coming out tomorrow, a few more earnings, consumer sentiment on Friday, and we've just done a pretty good bounce back from last Monday's low. Could be in for a period of consolidation, especially going to Jackson Hole next Thursday. Market might be a little worried going into that, may see a little bit of risk off, and markets always trade in waves. So we've had a pretty good up wave here. Say a little down wave is just around the corner, and like I said, I really didn't like what I heard from Mike Wilson today. That makes me want to buy some portfolio insurance, which luckily looks to be getting cheaper by the day as well. I'd be really surprised to see the VIX trade below 15, and if it did, I'd be inclined to take advantage of that. Thanks very much for sticking with Click Capital, and I'll see you again tomorrow night. Cheers.